This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the American Monetary Association's podcast, where we explore how monetary policy impacts the real lives of real people and the action steps necessary to preserve wealth and enhance one's lifestyle.
It's my pleasure to welcome Norm Champ. He is partner in the New York office of Kirkland, Ellis LLP, where he heads up the regulatory solutions practice in the investment funds group. Previously, Norm was director of the Division of Investment Management at the SEC, and he is the best-selling author of two books. One is Going Public, My Adventures Inside the SEC and How to Prevent the Next Devastating Crisis. And then the new book, Mastering Money, How to Beat Debt, Build Wealth, and Be Prepared for Any Financial Crisis. Norm, welcome. How you doing?
Great. Thanks so much for having me.
Yeah, it's good to have you. So first off, I want to talk about the next devastating financial crisis for a moment. Can you speculate with us, what will be the next recession? In other words, what will be the flavor of it? What will lead it? I don't know that it's going to be real estate this time around. The mortgages have been pretty tightly underwritten coming out of the Great Recession, but certainly student loan debt, auto title debt, credit card debt, corporate, I don't know, sovereign debt. Where's the next one going to come from?
So great question. The first lesson of all the ones in the past is, of course, they all started with something no one expected, right? So, we usually have some cause of a recession that no one's looking for. I do think the things you identified, the debt that we have put on in the last really now 11 years, that debt is going to, I believe, will lead the next recession. Now, I'm not smart enough to predict exactly which part of that debt, but it's hard to imagine that it's not somehow going to involve the levels of debt that both consumers and countries have taken on over the last 11 years since the crisis. I think that the prospect of what sets that debt off, I agree with you. I think mortgages are in better shape than they were in 2008. However, the FHFA has lowered the down payment to 3%. Again, they did that just 2 years after the crisis, which was a real tragedy in my view. And so there are, aggressive mortgages out there, but it's just we have a lot of debt. Consumer debt had gone down after the crisis to lower levels. We've now set records for several years straight. Governments around the world have taken on a lot of debt. Something is going to set off the next recession, and it's going to involve all of this debt.
Yeah, who knows? It's I'll tell you one that I read an article recently about how they want to let the banks get into venture capital investing. Oh my God, that sounds like a disaster waiting to happen. A highly risky venture capital portfolio for a bank. Oh, there you go. But I don't know. I could be wrong. They say they think it'll help small businesses get access to capital, and that'll obviously stimulate the economy. But some of these ideas seem pretty crazy to me.
We'll see. Those adjustments you're hearing about are really about the Volker Rule. And Volker Rule, I was involved in writing the Volker Rule after the crisis. And It's a very complicated rule. And so you are seeing discussions about various adjustments to it. We'll have to see how those play out. It is, I agree with you. I think it's just hard to know exactly what sets it off, but there is an awful lot of debt around the system.
Yeah, there is. Let's talk a little bit, in part one of your book, you talk about, the spending governor, right? And you talk about debt and this concept of home ownership, which I have long said I think is highly overrated. Personally, I'm probably like the only real estate person that ever says the homeownership rate should decline. I think it should be 50 to 55%, and everybody else says it should be 70%. But what's so interesting about that is that when people own homes, they're kind of stuck, right? They can't move as easily to where, job opportunities might be. Where did we get off on this American dream idea that everybody should own the house in which they live? Now, I love real estate investing, of course, but, the home in which you live is not necessarily something that needs to be owned, is it?
Not at all. And my main message in that chapter, and as you say, part one of the book is really, trying to cut down on the outflow. So we live in a consumer society and people are urged to spend every day. Some of the things we talk about are the apps that are doing automatic charges and all these ways that you're, urged to spend. And so the first part of the book is really, let's try to get spending down. Second part, let's try to get income up. And then once we get there where hopefully we're out of debt and we have a net worth, then how to do some responsible investing for the future. Now, I devote a whole chapter to home ownership because I couldn't agree with you more. It is a pervasive, trope in American world that you should own a home. This is the route to wealth. Now, if you talk to the people that were foreclosed on in 2009, 2010, after the crisis, they are not going to tell you that home ownership was the way to wealth. The argument I'm making in the chapter about the mortgage trap is that it's a mortgage to own the home you live in is a financial decision like any other. Now, you wouldn't know that because the government gives you guaranteed mortgages. So we have 30-year mortgages, which other countries don't have. The government gives you low interest rates, and the government gives you mortgage interest deduction. But I go through each of those pieces and try to give people real concrete tips on how to evaluate whether a home is the right, owning a home is the right decision for them. As you point out, a home restricts mobility, restricts the ability, can be, if you get in trouble, can be a mortgage that really hurts your credit rating. And some of the tips I share are, okay, if you're going to be there in that town for 5 years, then homeownership may make sense. If you can come up with a significant down payment so that your risk of getting underwater on the mortgage is low. There are circumstances where it can work, but this idea that it's for everyone and for everybody and it's for every time and it's a way to create wealth, unfortunately, is just not the case.
Mm-hmm. Yeah. So what are some of the ways someone can tell whether or not, they should buy a home? You said you have some, I guess, metrics for that, right?
Yeah. I mean, if you're going to be in a certain place for, 5 years or more, be either, maybe that's through personal or, your job, or if you've got really high confidence on some element of being there for long term, then, owning can be better. I think that a significant down payment is probably the single most important thing. You cannot, people getting into these highly levered mortgages are the people that got in trouble in the last crisis. You've got to have an emergency fund. So need to be able to put aside enough money so that if you lose your job or unfortunate health issue or what have you, you've got 6 months that you can, put aside that you can survive on. So there's certain things that have to be in place before you should consider it. The payment should be something that you can handle easily, not something you're really stretching for. So it can be done, but the incentives that our government puts out there for it distort this market, encourage people who probably shouldn't take the plunge, and particularly on the younger side, early in people's career, mobility, moving around, renting may make more sense. I always laugh and I talk about this in the book, I always laugh when people say, well, if you rent, that's just throwing money away. Well, of course,
that's so stupid. That is so, right. that is just the dumbest idea ever, people need to understand that you have to pay for things, right? If you go out to eat, you got to pay. If you cook at home and buy groceries, you got to pay for the groceries. Well, if you have a place to live, you got to pay for it too. It's just a difference of whether you own it and pay a mortgage or you pay a landlord for the use of that property. It's the absolutely silliest statement ever.
And if you think about it, what are you doing in a mortgage? You are renting the money from the bank, right? So, if we think we're throwing away money on rent, we're also throwing away money on interest. So I'm not totally against it, but I'm just trying to get people to separate it from all the noise. Right. Our government really likes to urge home ownership. I think it's partly because it is one of the levers in the economy that the government can pull. Right?
Yeah,
the government
and they can get fast results with that because if they get people to go buy houses, then they're going to spend a whole bunch of money, improving that house. And, there is a little concept, though, that I think is valuable. And that's the concept of, like the ownership society, right? Just psychologically is how I mean this. when people sort of feel like they have they have roots, they have an investment, a lot of times it makes them more responsible human beings. I think there is some element of that. I'm not saying it wins the day. I'm just saying it's there. Thoughts on that?
I totally agree. And in fact, one of the things I would like to see, I live in New York City, and we've been through a terrible series of scandals with the New York City Housing Authority and lack of repairs and deferred maintenance and, all these things, and lead poisoning of people who live there. I mean, just terrible things. I would be an advocate of simply selling those properties to the people who live there, because once that we move to an ownership, society and ownership ability, then those folks are going to be motivated to take care of the property themselves. And so I'm with you. I think that, ownership, there is an element of ownership that is beneficial in some of these situations.
Yeah, well, certainly, just having welfare recipients get free houses, they're not going to care about them. They don't obviously take care of them, for sure. I couldn't agree more. Talk to us a little about your experience at the SEC, if you would. Of course, the SEC has been widely criticized, many times in history, and the companies that they're investigating exert influence over investigators a lot of times. Just give us some insight into all that, if you would.
Sure. So the first book that you mentioned at the top, Going Public, is all about what it's like to go from the private sector to the Securities and Exchange Commission. I went there immediately after the global financial crisis in 2008 and was tasked with trying to remedy some of the issues that had resulted in examiners missing Bernie Madoff, Alan Stanford, despite examining them.
Right.
And so, we really spent a lot of time reorganizing the SEC, working on trying to get its processes better so that those kind of misses wouldn't happen again. It is, it's a small agency. It's only about 4,500 people, and they are tasked with, regulating what are the best capital markets in the world. And a lot of what we were trying to do was get more process in place. A lot of things had grown up over time, kind of, ad hoc. And we were really trying to get more procedures in place, make sure that examiners, for instance, had a framework in which to do their jobs. I think the vast majority of people go there trying to do the right thing and are dedicated to trying to make sure that we have good markets and that we have, protect investors and that we continue the great tradition of capital formation in the United States. It was a privilege to serve there. And I think that there's a lot of good. There are issues, and I think they continue to work on those, but there's also a lot of positive.
Let me ask you. So, after the Jobs Act and this massive expansion of the world of crowdfunding, and, is the SEC regulating any of that stuff? Or maybe the proper word isn't regulating, but punishing the bad players? I think it's pretty neat that, small players can now raise funding more easily, but of course there's going to be just mountains of fraud and bad actors, and just expect that, right? Will the SEC go after these little fish, or does it have to rise to a certain amount of size for the SEC to get interested?
So it has to be a violation of the federal securities laws, and if you offer securities and they're unregistered or they're not able to take advantage of a crowdfunding provision, then it is, it can be illegal. They have brought many cases. In fact, they bring more than 800 cases a year. And really, the vast majority of those cases, in fact, are smaller cases. So you sort of hear about the cases involving the big banks or big firms.
Right.
Most of the cases actually are much smaller. And in fact, a big chunk of them are something called affinity fraud. And it's not too far off from crowdfunding in the sense that affinity fraud is, you have some money to invest and there's a nice young man at church group, and he says, I'll invest it for you. And of course, you never see it again.
Right.
And that, I believe, relates to kind of a fear of investing that a lot of people have because we don't do any financial literacy education in the United States. And so what the SEC actually, the plurality of the cases they bring are the affinity fraud cases. And so much of what I was trying to do in the book, Mastering Money, is to demystify savings, demystify investing, try to help people find some ways to invest. Mutual funds are highly regulated by the SEC. They may not, it's not the SEC guarantees they're going up or down, but we haven't lost any money in frauds on mutual funds. And so I really make an effort in the book to try to direct people towards, at least when they're starting out, to make sure that they invest in mutual funds because, again, they may not go up, but you're going to get market exposure and your money's not going to get stolen.
Let's go back to affinity fraud for a second. I mean, affinity fraud sounds like nothing more than basically what Bernie Madoff did in the sense that, I mean, he did more, but he started in groups, especially Jewish groups and charities, where he would be involved and, become buddy-buddy with everybody. And, they would invest with them because they think, hey, the person is involved in this charity with me they're not going to rip me off. I know them, right? Is that all you mean by affinity fraud? Is that
it is. I mean, he in particular, you're absolutely right. He preyed on the Jewish community, but it happens in all sorts of religious, community, racial, ethnic. It's
mastermind
usually
groups is a big one now.
It's usually somehow related to an area where people feel comfortable. And my theory is that derives from fear of investing. People are worried about, putting money to work. And so they turn to someone trusted like that. What I'm trying to do in the book is hopefully give people the tools to say, listen, okay, got the expenses down, I got the income up, got the debt paid off. Now I have 50 grand, 100 grand to put to work. I kind of went out on a limb in the book and said, listen, till you get to 500 grand, I don't think you need anything more than mutual funds. And, they are and then of course I talk about asset allocation, but there's no reason not to, and you can, to open a mutual fund account, invest in mutual funds. And those are, it's so easy now. You can do it online, reputable firms. Again, there's no risk of your money being stolen. Unfortunately,
the problem is though, with any sort of fund, any pooled money asset, mutual fund, whatever, even just a direct stock, you've always got the people that run the thing that skim the cream off the top, and that's not necessarily illegal. It usually isn't. You say there's been no fraud in the mutual fund world. Well, I don't know. People would argue with you on that one for sure, because there may have been no illegal, caught fraud example, but, people have their hand in the cookie jar. They pay themselves giant bonuses, they fly the private jet, and who's paying for that? All the investors are, right?
Well, if you look at, I would have to take issue with that. If you look at mutual fund expense ratios, you will see that they are the lowest they've ever been, and they continue to plunge. And you can, if you're worried about expenses, you can invest in index funds, you can invest in ETFs that follow indices. And those, we're really talking about, we're getting to the point in ETFs that it's almost zero cost products. And so, I think, now look, fees, I don't disagree with you that fees, you have to look at fees. And if you pull up a fund and it's got 2 or 3% fee, then that's not correct. But I think you'll find that most of them are hovering around, 1.25 and below, many below 1. And those kind of fees are, not going to inhibit your returns. So fees are important, but they are plunging in the mutual fund industry. It's why we're seeing huge consolidation in the mutual fund industry. So the big are getting bigger, and that's because they can charge these low fees with scale. And it's, some of the smaller players are getting hurt by that.
Yeah. So the ETF, as my friend put it well, I thought, he said, at least if you invest in an ETF, you're only susceptible to the graft and corruption of the executives and the board of directors, not the fund manager. That was pretty good. Do you love the cynicism here? But there's always, whenever there's a big thing and a big pool, there are people that have to run it. And so, I just wish there were some way to control that and not allow these kind of ridiculous amounts of spending by these folks. I mean, coming out of the Great Recession, remember when the CEO of Merrill Lynch spent over $1 million to decorate his personal office within the building? That was in the news. And, he ended up paying that money back to the company. Who was it? John Thane, I think, there's all these abuses like that, right? So, we're not going to do anything about it. But it's just frustrating, right? It's just kind of frustrating. But tell us about the Volker Rule, if you would. Paul Volcker, of course, our late Fed chair, the guy that many credit with breaking the back of inflation, making a very unpopular move in the early Reagan era. What's involved with the Volcker Rule? You've got a whole chapter on it.
Yeah. So the Volker Rule was intended to be a rule that effectively would replace a statute that we used to have in America that was called the Glass-Steagall Act.
Yep.
And Glass-Steagall, from the time of immediate post-29 crash until the 1990s, Glass-Steagall kept commercial banks and investment banks, i.e. broker-dealers, separate. And then in the 90s, with sort of the wave of the financial supermarkets, a lot of mergers, Glass-Steagall got repealed. In my book, Going Public, I argue that the simpler solution would have been to put Glass-Steagall back in place. I'm not a huge fan of the Volcker Rule because it was a more than 1,000-page attempt to essentially allow banks and brokerages to stay together, but create this long, complicated rule to try to separate the insured activities from the uninsured activities. So the whole issue with Glass-Steagall or with Volcker or with the crisis, right, is you don't want banks taking bets, making bets on markets or funds with taxpayer-insured money. So you don't want them making their own bets with money that the taxpayers are going to have to replace.
Okay. So
FDIC.
let's just drill down on that for a minute. So FDIC insurance, $250 or $250,000 per account vesting, okay, is the insurance that was increased from $100,000 during the Great Recession. And so we've got this insured pool of money that the bank manages, right? They take deposits, it's FDIC insured. Now, how do they get the other money that they just have brokerage divisions, you mean? Simply
Yes.
that, right?
Yeah,
okay.
right.
So, yeah. Okay, so tell us more about that.
The financial supermarkets that came along in the 90s, most notably Citibank, was one of the advocates of getting rid of Glass-Steagall. Mm-hmm. The idea was, listen, don't make the commercial banks stand on their own. Don't make the brokerages stand on their own. Let's have them all in one. And so since the 90s, that's been the case, right? You have these huge, financial conglomerates that have both brokerages and banks. And through brokerages, they are making money through commissions and through underwriting and all the activities that brokers do. And that's money that the broker has made, then they can invest or do whatever they want with or distribute. But the idea is you want the commercial bank side of the business to not use that money to do whatever it wants with because you don't want the taxpayers to be on the hook. And I'm very much behind that. That's why I'm in favor of reinstituting Glass-Steagall and simply separating the two. Volcker Rule is effectively a compromise saying, well, we're not going to go back to Glass-Steagall, but we'll write this rule to try to separate the activities so that people are not, banks are not making investment bets with taxpayer-insured money. I just think it was a very complicated undertaking. I was in the room many times when it was being written, and I would prefer the simplicity of simply separating the two.
So I think people, where they have trouble understanding what this really means, is that my bank, for example, I have a brokerage account at one of my banks, and then I also have bank accounts, just FDIC insured accounts. But the money in that brokerage account is not the bank's money, and the bank, I don't think it's insured, and the bank never told me it was insured. So the bank's not playing with insured money there, or I don't get it. So what's the big deal?
So the idea was, you're right. You have your bank account, and the bank in theory isn't playing with that. You have your brokerage account, and also, you understand that's not insured. The problem is, if all this is owned by one institution, right?
Yeah.
That institution gets in trouble, generally. I was going to say generally on the brokerage side, but it can be either side, right? Last time it was really on the bank side with mortgages.
Yeah.
Lots of times it's been on the brokerage side with, trading losses, those kinds of things. If the institution gets in trouble and is now beginning to violate its capital requirements or suffer other distress, then the government may have to step in and help them, because the theory was after the 2008, crisis that you couldn't have these banks fail, hence the term too big to fail. So if the government steps in to bail out that bank, well, effectively taxpayer money is going to bail out, and it doesn't necessarily matter, kind of which way it came from, right?
Mm-hmm.
Which side. And so that's why I think separating them out would make it much easier, because you would go to your bank and they would have an account for you. They would pay you interest on it. They would lend you money for your mortgage we talked about earlier. And you would go to your brokerage and you would understand that those are different activities that you're doing there. And it would also make it simpler, to your point about when we're trying to figure out what's wrong with the institution or it has a problem. It'd be much clearer which side of the house it was from and which side the government might have to get involved in.
Right.
So,
yeah.
You're pointing to the very complexity that I always oppose the Volker Rule on, because you're really trying to draw a line in they took them over 1,000 pages to do so, and I still don't think they did a very good job.
Right. Yeah, it always gets so convoluted in the political world. I don't know how the powers that be keep track of something, and look at all the implications of something like Dodd-Frank or Obamacare. I mean, these are just giant pieces of legislation, and their effects are so wide-ranging. It's absolutely absurd. So, when you were at the SEC, you helped stabilize trillions of dollars of investor capital. Tell us a little bit about that, and we got to wrap it up soon, but just would love to hear more about that experience.
Sure. That references to something I talk about in the book, which is, and happily, something that never, got out into the public. It was reported much later, and I do describe in the book. But essentially, we had, after all the failures of the fall of 2008, I got to the SEC, in early 2010. We had the prospect of an additional brokerage failure, and what we did there was, we did not bail out that broker, but we were very instrumental in working with that broker. We had examiners on site. We monitored the situation constantly. We helped that broker find some alternatives, which in the end included selling part of itself. And so, there were a lot of behind the scenes efforts going on inside the government to make sure that we didn't have further failures. Again, not with government, the SEC has no budget for that kind of thing. So not to provide bailout money, but simply to work with institutions and try to stabilize them to make sure that we didn't have investor losses. And I feel like, so much of that activity was behind the scenes and was trying to make sure that we didn't have further problems, which would have further damaged investor confidence, right? So much of our markets depend on investor confidence, so you sort of see, last Friday, the coronavirus markets dropped. There's a big psychological element to markets and to, capital raising. And so, we spent a lot of time on those pieces. We also spent a lot of time making sure that the SEC would be more effective at going out and working on firms and looking at them and making sure that they would spot problems with firms. And I think the SEC's come a long way on that front.
Yeah, good. One of the criticisms of just the way the system works is that you can have these SEC examiners looking at a company, and that company can just offer them their next job. Are there any things to prevent that? Or, a lot of times these private companies, obviously, they can pay a lot more than the government. And, I can just envision this concept of these SEC examiners are in the conference room of this big company asking for documents or asking them questions. And they say, well, why don't you come work here? At 3 times the pay. Does that happen, or is that a mythical idea?
So people do move back and forth between government and the private sector. I would say that it is more at the more senior levels of the government. So the folks in the exam program at the SEC and a lot of the staff at the SEC, I would say the vast majority of them are career folks who are there for a long time. It's a very good job, has great benefits, very secure. It's very difficult to be fired. And, so I would say most people stay. And so the sort of this idea of a constant revolving door is not, you're right, it's out there, but it's not that true. It does happen. Sure. I moved from the investment management industry into the government and then out into a law firm. There are some pretty stringent things in place. So, for instance, I was unable to do anything involving the SEC for the first year that I came out. And then even after that, I'm not allowed to do anything that relates to anything that I worked on while I was at the SEC. So there are some very strict ethical rules in place. And I always point out in these conversations, remember the positive, right? We do want to have people inside the government who understand markets, understand financial institutions, can bring that knowledge to bear to help protect investors. So there is a positive to getting industry knowledge. We wouldn't want regulators where you have people with no knowledge of the industry.
Mm-hmm. Yeah. Oh, no, I agree with you. But that's when they come one direction, the sort of the example, and then, they could exhibit favoritism toward a given company in that's the downfall of that concept. And I was kind of explaining it happening the other way, where they're suddenly taken off the case. They're not investigating the company anymore. And now they're working for them. And I'm like, my God, it's just some of these large players have so much money. They can just buy their way to freedom. It's like buying off the prosecutor or the judge, that kind of thing concerns me, but hopefully it's a relatively small number of times that it ever happens. Any comments?
Yeah, I think I would say relatively small. No, right. I also think that if someone left government in order to then sort of help a company that had been, auditing or something, there's a lot of eyes out there who would see that. And I think it would be revealed pretty quickly. So I think the benefits of some circulation between the private side and the public side outweigh the negatives.
Mm-hmm. Yeah. Okay. Norm, give out your website and any final comments you have about, preventing the next crisis or whatever. Let's just wrap it up.
Okay, great. Yeah. So please go to normchamp.com and you'll see updates on both books. Mastering Money is out there, doing a lot of publicity for it right now, going public still on Amazon as well. I think that my last thing would be that really Mastering Money is kind of the passion project. I believe fervently in giving people the knowledge to manage their personal finances, try to give them some of the tips, try to take away some of the fear. I'm also available to do group events and, bring books and that kind of thing. So we'd be happy to speak to any groups that think it might be helpful to them.
Excellent. Norm, thanks for joining us.
Great. Thanks so much.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.